Hey everybody, welcome to the webinar today. We'll give everybody another minute or two to get settled in and we'll get started. Okay, so I think we'll get started. So good afternoon and welcome to today's webinar on the SEC's stated rules on climate-related disclosures. I am Jeff Spindler. I'm a partner at Baker Hostetler in New York's office. Today's presentation will provide an overview of the SEC's pending final rules requiring specific climate-related disclosure. Today's webinar offers both CLE and CPE credit. During the course of today's presentation, you will be provided with codes. Following the completion of the presentation, you will receive an email asking you for the codes to confirm your attendance and receive CLE credit. Also, during the presentation, you will receive challenge questions to confirm your attendance and receive CPE credits. At the end of this presentation, we'll leave some time for a 5 to 10 minute Q&A session. So I'm going to start with a general overview of the ESG rules. Please note that the rules for today, the SEC's rules we discuss, are not yet in effect. Multiple attorneys have generally challenged the rules in multiple federal circuits. The cases were consolidated through a random lottery to the Eighth Circuit Court of Appeals. Following that consolidation, the SEC voluntarily stayed the rules pending an appeal, and the U.S. Chamber of Commerce, the Sierra Club, trade associations, and others have filed briefs in support of the Eighth Circuit brief. There remains a likelihood that the rules will survive challenge and otherwise become applicable. Companies should become aware now and begin to think about preparing for compliance with the new rules. The final rules will add a new subpart 1500 and Article 14 to both Regulation SK and Regulation SX, respectively. The final rules require the disclosure of material Scope 1 emissions and Scope 2 emissions metrics by large accelerated filers and accelerated filers on a phased-in basis. Non-accelerated filers, for example, smaller reporting companies and emerging growth companies, will not be required to report on Scope 1 and Scope 2 emissions. Compliance is expected to phase in for large accelerated filers from 2025 through 2023, then for accelerated filers from 2026 through 2031, and to a limited degree for other filers from 2027 through 2028. The final rules were slated to become effective and begin phasing in on March 27th, 2024, though the challenges I previously mentioned to the final rules delayed the effective date. Phase-in dates mentioned here will be tied to a new effective date with the SEC's voluntarily stay, and we lifted the final rules to survive the consolidated challenges pending the Eighth Circuit Court of Appeals. Nearly 2 years after the SEC released the proposed rules on climate-related disclosure, the SEC adopted the final rules on March 6, 2024 in a release dated and numbered 3311275, which will require disclosure of climate-related information in registration statements and annual reports. The rules prompted more than 24,000 public comments. Compared to the proposed rules, the final rules eliminated all Scope 3 emissions reporting, conditions disclosure requirements on the materiality standard, and do not require material changes to climate-related disclosure to be reported on quarterly reports on Form 10-Q. The final rules require registrants to disclose material climate-related risks and actions taken to mitigate or adopt such risks, broad oversight of climate-related risks and management's role in managing those risks, and any climate-related targets or goals that are material to the registrant's business, financial condition, or operating results. I will now turn it over to my colleagues at Deloitte and Baker for a more in-depth review of the details of the rules.
Thank you, Jeff. My name is Matt Speraza. I'm a securities attorney in the Los Angeles office of Baker and Hostetler. I'm going to go over briefly an overview of some points within particularly the new subpart 1500 to regulation SK, and turn it back over to Deloitte for a moment before getting back into some detail about that same topic in regulation SK. The first point is where the disclosures will take place. For domestic registrants, the new subpart 1500 of regulation SK will require disclosure of GHG emissions and related topics. Those disclosures will appear for domestic registrants in a item 6 of Form 10K. That item was previously reserved and will now be used for these new rules if they survive the existing challenge. Foreign private issuers will be required to make the same type of disclosures in a new item 3E of Form 20. All registrants will be required under regulation SX, which Deloitte will get into more detail about, regarding the severe weather events or other natural occurrences in financial footnotes, subject to certain reportability thresholds. The final rules will require certain things of different registrants depending on their category, whether you're a small reporting company or a large accelerated filer, puts you into the non-accelerated bucket, or if you're accelerated filer versus a large accelerated filer. There'll also be some rules that apply to all statuses. Those generally applicable disclosures are first, oversight of climate-related risks by the board of directors, as well as how management plays into that. There will be material climate-related risks, assessing both physical and transition risks, where the physical risks are those presented by generally nature itself, such as severe weather events. And the transition risks are the risks inherent to the companies adjusting to the physical risks, particularly the change that will result during the transition in shifting towards a lower carbon future. The next category will be actions taken to mitigate or adapt to the risks that I just mentioned. Disclosures for that should explain how the registrant identifies those risks, prioritizes them among various other risks, assesses the materiality of the climate-related risks, and how those are offset to address the risks. The next category we'll get into are climate-related targets and goals that are material to the registrant's business, financial condition, and results of operation. The disclosures for those are required when targets or goals have, when they are reasonably likely to materially impact the registrant's results. That can include things like conserving water, conserving energy, or using low carbon products. With that, I'll turn it over to Deloitte.
Thanks, Matt. Hi, everyone. Ben Tillmans with Deloitte. As we go dual purpose here today for the lawyers on the line as well as the accountants, knowledge check questions for those looking for CPE. There will be 5 throughout today's session. As you can tell by the first question on the screen, not a right or wrong type answer, but if you are looking for CPE today, please make sure you answer the questions. First question, how familiar are you with the requirements of the SEC climate disclosure rule? And we'll give these a minute. There's 3 here to start, and then we did 2 at the end. That way we're not being peppered throughout.
Yeah, and Ben, I might say too, for those listening, right, the SEC is the rule we're discussing here. But also remembering there's a lot of other rules coming on board with similar requirements. I believe many here are probably familiar with the California rule, which has similar climate related disclosures, but probably more prominently right now as far as action is the EU's CSRD rule. So, while we're talking about the SEC today, and there's a lot of crossover for the SEC requirements, make sure you're keeping in mind the broader global regulatory framework.
Okay. Second question, just what is your background? Legal, expecting a lot on the first two, legal, accounting, finance, but may have a few others, governance, risk, controls, and we have an other category, so we'll see.
Hopefully everyone gets this one right. Your own background.
Okay. Okay, give us another minute and then we'll keep moving. That for those looking for CLE, there are also the traditional code that myself as a CPA, I don't have that full understanding of the process, but CPE, a few questions here. And then whenever you think we're at a critical mass, feel free to keep us moving. Okay, looks about 60% legal, 40% accounting adjacent, and other. Question number 3, what is the readiness level of your organization with respect to the climate disclosure rule? We're ready right now. Not sure that many organizations are ready right now, want to be ready, but there may be a few. Somewhat ready, still work to do, and some beginning the readiness journey. I'll piggyback what Robert said as well. There's many organizations that we know are starting the broader ESG journey domestically and globally. So I would expect most in B and C here, but we'll see what the results are here in a minute. Okay. For the 5% ready right now, good for you. Certainly not the norm, but okay. We will keep it moving. And then the first CLE, or I'm sorry, CLE code here.
All right. Matt, is this you or I?
This is me. So this is the material I was mentioning a moment ago to touch briefly on these. The first part I mentioned was the oversight piece that the board and the management will do together. This can look like different things. It can be the board doing this as a whole, or there can be a special committee dedicated to it. At the management level, it can be a disclosure about what the management is doing or how employees are reporting up to management and having a reporting structure there. Second, the material climate related risks, addressing physical and transition risks. This is going to have to get into some particular climate related disclosures about both the short and long term for both the physical and transition risks. This one can come up a lot, especially where companies are adjacent to certain risks. Out here in Los Angeles, surfing is a big thing, and there's a water treatment plant very close to the beach here. If you're out there on the water, one thought that can cross your head is, when will a wave large enough come through to flood out this water treatment plant? How are they going to address that for this week versus the next 10 years? I think those are the kind of questions that these disclosures are going to be getting at. They're also going to be getting at, if the company needs to make some material changes to the way it's operating in order to address that, what are the risks inherent to those changes and how are those going to be addressed? These actions to mitigate, in the next bucket here, the actions to mitigate or adapt to such risks, is trying to get at the idea of what is the company going to do given the risk and the actions they plan to take to mitigate those. And this is all of the balancing. Is this risk more important than some other risks that may not be environmental? And which is more material? That discussion will be in these disclosures. This next bucket on the climate goals, we have to tie this all back to the bottom line of the company, how the financial condition is impacted, and the operating results. So that'll be its own discussion particularized to each company.
Thanks, Matt. So Robert Kerr, partner based in Atlanta for Deloitte. I'll talk through SX and kind of tie it into what Matt spoke about on the SK, because, while we've talked about this in two sections, they're really inextricably linked. And I'll give you a couple of answers there. One is, the financial statement, SX is the financial statement subject to either the auditor opinion at year end, or, review procedures at the interim, as well as management's attestation. And so a lot of people think about it a little bit more strenuous, although Matt's going to talk about assurance requirements for scope 1 and 2, that obviously come online and have that same level of rigor. A couple things I point out from the SK that can impact SX, and it's a bit of a hidden, I'd say, gotcha if you don't pay attention. One is, if you have a net zero target or transition plans or disclose significant cost of meeting net zero targets, that triggers SK disclosure requirements, but those costs can trigger SX requirements. So one thing to keep in mind is your SK and SX are very much connected, especially when you talk about financial statement costs and risks, which I'll get into the other SX disclosures here. And the other one, Matt, that I've run across the clients is, it definitely explicitly removes the requirement for scope 3, but if you have a net zero target, you have cost of meeting that, it could pull scope 3 in again. So I would say just there's really this holistic view from a risk and disclosure perspective that you're going to have to take as you're adopting this standard. But from an SX perspective, I really think of it in 3 buckets here. You see the bubbles here to the left. So estimates and assumptions, that really comes in around measuring a lot of those costs around a transition plan, around a net zero effort. If you recall the original rule, there were requirements to disclose cost, to disclose progress, how you were going to get there, and those costs. That now, again, is under the guise and SK of if material, if you have them. But if you do, you've got to carry that through to SX based on a materiality concept. The biggest piece of SX, I would say, is around this severe weather and other natural conditions events disclosure. And that's different from the original rule, which was climate-related disclosures. And the question there, and a lot of those 24,000 comments was, well, how do I know if the weather event's climate-related? What this rule has done is made this not prescriptive, but more objective and more risk and cost-based. And so what the rule would have you do, and if we can go to the next slide there, is basically come up with an identified set of weather events and natural conditions that have impacts to your financial statements. Now, if you read the rule in all 900 pages, it'll give you some examples, but it actually will just tell you, look, there is a policy you've got to develop to come up with what those weather events are and natural conditions that you're then going to disclose against. So, the current is, Southeastern Hurricane Debbie. Generally, I think people would say, well, hurricanes is a weather event. And so the 18 to 24 inches being dumped across the panhandle of Florida into the low country in South Carolina could cause loss of buildings for public companies. And if so, that may be an event that you have to track. The key there is that this is now in the financials. And so once you come up with this policy of here are the weather events and natural conditions you're following, you've got to put SOX controls in place. And that is not a new concept, obviously, to public companies. But what can be challenging is a couple things on this front. One is that this is a new concept. The broader discussion I have with clients and Ben and I do on these ESG regulatory disclosure rules is, this is like putting financial statement disclosures in place, but it's brand new types of data. And so you've got to familiarize yourself with what does scope 1 and 2 and 3 potentially mean? What is a transition plan to what Matt was describing? And how do I think about that data? And yes, everybody knows what weather is. You may not know what a natural condition is, which can be things like droughts, things that are more chronic in nature. again, as your policy described. So you may know what those are, but you never measure them. You've never had a control in place that said, here's the damage caused by wind and rain necessarily. The other piece of here I would put to the left side that's actually what's getting a lot of people talking is the threshold. So within your financial statements, if you have costs or expenses that exceed 1% or 100,000 of your pre-tax income in aggregate, again, and that's the key, in aggregate, not individual events, you've got to disclose those, disclose what line items they're in, disclose the impact on your annual financial statements, and you have to do it gross of insurance proceeds. So you can't just say, I've got insurance to cover all my losses, I don't have disclosures to do. That's a pretty low bar. If we think about SEC filers that are profitable, a typical materiality range can be 5 to 10% of pre-tax income, depending upon industry and company specific items. And so if you think about that, designing a control down to 1% of pre-tax income or $100,000 is pretty low, and is a level of precision that many company control environments aren't built for right now. From a balance sheet side, where you have losses to accrue, typically capital expenditures to incur or impairments that happen, it's 1% of your absolute value of your equity, net equity, or 500,000. So yeah, they give you a little bit of relief by saying 500,000 is de minimis, but again, on net equity, that is a low number. And so one of the biggest discussions we have with clients is, okay, how do I define this policy, and then how am I going to keep tracking this to disclose in the financial statements under audit, again, subject to management's attestation as well as auditor attestation. And so that's the one piece that is new. It's the piece of this rule that is not in the other regulations like California or the CSRD or ISSB to date that's come out. And so it's one where you want to spend some time getting ahead of it and really just understanding an inventory of what type of weather events can impact my business or natural conditions, and how am I going to measure them at this level of precision, or I might have individual events even under this amount because I've got to disclose in aggregate. So that's really, I would say, one of the bigger impacts. It's a new concept. Now, it's better than the old rule, which was 1% of each line item in climate-related events. So there certainly is relief here. It certainly is more objective by saying weather events, not climate-caused weather events. So there is a bit of an easier aspect to that. But again, a low threshold that you have to think about. The other aspect of disclosure, and this actually kind of ties in with timing of new FASB rules, is around renewable energy credits or RECs or carbon offsets. So typically, unless you're a company that trades in these, which is not too many, you're going to have RECs or carbon offsets because you are trying to essentially help your company or your organization achieve a net zero target. Again, going back to what I said at the beginning, that's interrelated to having a net zero target, which means you now may have more disclosures in SK, which then brings more disclosures in SX. So again, I go back to the theme of this is a holistic rule that you really can't think about in a silo. But if you have renewable energy credits or carbon offsets, dependent upon how you treat them, meaning do you hold them for inventory to buy and sell, or do you buy them to cancel them and offset carbon, can determine your balance sheet income statement treatment. What I would point you to is the FASB has an exposure draft out there specifically around treatment of carbon credits, and so I'd encourage you to look that up. But what this disclosure says is if you have them and their material, you've got to essentially disclose a roll forward of beginning balance, what you bought, sold, used, and what your ending balance is. So just keep that in mind as you think about your strategy and risk as you're figuring out what your SK disclosure is. If the answer is, I've got a strategy of getting to net zero and I'm going to do that with carbon offsets, you likely have an SX disclosure requirement that you're going to have to disclose. And so again, companies are disclosing these. This is not a new requirement to disclose because they are treated as assets on certain companies. But I think this aligns some specific requirements by the SEC as well as allows for alignment with the new FASB rules to all come together to, I'd say, a consistent, cohesive disclosure strategy. The other piece to think about is, and a lot of you with financial statement background are going to be used to this with the Rev Rec and lease standards, but the SAP 74 disclosures, and what is the potential impact to this rule, and where do I disclose that, and when do I disclose that? If we think about back to the 606, ASC 606, the new Rev Rec standard and the new lease standard for those that aren't the accountant's controllership, usually by Q2, Q3 of the year before adoption, there was a section that basically said, here's what the impact's going to be because we've done this work. And so you do that with any new disclosure rule from the SEC or the FASB, this would be no exception. And so it's not that you want to wait until the year of adoption to do something. You really have an obligation under SEC rules based on materiality to think about the impact of this adoption ahead of time and disclose that when it's known and knowable. So that's another thing to keep in mind when you're talking about timing. Like, I know we've talked about it, and Matt will get into it a little bit later. What are the challenges? Why? What's the timing, right? The SEC stayed this rule in part because they didn't know if the challenge would be done by the end of the year, and they didn't want to be in a position necessarily that might have said you've got to comply with the rule that is being challenged. But they came out when they did stay the rule and said, we categorically think this rule is going to stay as it is. This is not an indication we don't think it is. But nonetheless, we're going to be prudent and let this thing work its way through the judiciary. And so maybe the last thing I'd say here as it relates to financial statements, and I know Matt's going to talk about the actual scope 1 and 2 disclosures. They do give an ability, because one of the biggest comments was we can't get scope 1, 2, and 3 at the time done by a 10K timeline. That's just not possible. And so what this does allow is to either file a 10KA or in the 10Q, the actual GHG emission disclosures later in the year. So it gives relief on that timing, but still ties it to the financial statement. So that's something to keep in mind there. And so maybe as a quick summary, and I'll kick it back to Matt, right? You've got the financial statement effects of weather events. And really the way to think about it is develop your policy, realize you've got to put controls in place, and it's going to be at a level typically below probably what your pre-tax income-based materiality is for your disclosures. There is formal carbon offset and REC, renewable energy certificate disclosures, including roll forwards of activity if you use them. And then estimates, assumptions around anything else related to the material nature of your net zero targets, other targets that have to be net zero, can be water, can be waste. So again, not just the energy, and any other risks that you're monitoring, mitigating that have a financial statement impact, you're going to have to disclose those as well. So not the same extent of the original rule, but I would say don't underestimate the amount of effort to make sure you've got controls in place for proper disclosures in SX, presuming the rule holds up in its current form, which obviously we'll talk about a little bit later. So with that, maybe Matt, I'll kick it back to you to take up the mantle.
Thank you, Robert. I think I'm going to underscore something that Robert just said about the relationship between the SK disclosures and what ends up in the financial statements under SX. I imagine that one of the questions that the auditors are going to be asking the securities attorneys during reporting season is whether renewable energy credits and carbon offsets make up a material portion of plans and disclosures about climate-related items in the SK disclosures. Because if they do, that's the trigger, and we'll have to be coordinating on that front upfront to make sure that the financial statements reflect what's in the disclosures. Go ahead, Robert.
And Matt, maybe to tie it to what we're all doing now in controllership and with our, with SEC counsel, is the auditors have a current obligation to read the rest of the 10K for material inconsistencies with the financial statements. So while there's not an opinion on the SK parts of the document, we still have, as auditors, have an obligation to read that. That same concept is going to apply here, and it's just going to be more important when it's initially done because it's going to be new all around, which increases that risk of inconsistency.
That's right. So I'm going to briefly touch on some points about scope 1 and scope 2 reporting in this portion. The this portion depends on the status of the filer, whether you're accelerated or not. If you are not accelerated, which is smaller reporting companies, emerging growth companies, and it excludes accelerated filers, large accelerated filers, then there's no obligation under these new rules for scope 1 or 2 reporting, and there will be no phase into that type of reporting. If you're accelerated, you're treated differently depending whether you're a large accelerated or just a normal accelerated, in certain regards. So accelerated filers, large accelerated filers will have to disclose scope 1 and scope 2 to the extent material. And so will accelerated filers. They just have to report differently with assurance levels. To get into what scope 1 is, that's really talking about what happens on site. The rules call that the organizational boundaries. What I mean by that is the emissions from the operations that are owned or controlled, either way, by the registrant. Examples of that is burning something on site is a very obvious example, and that's contrasted with scope 2 emissions that are not in the organizational boundary. It's talking about emissions from the generation of purchased or acquired electricity, steam, heat, or cooling that are consumed. So this is talking about your lights, power generation, that's required for that sort of thing. And the new rule, unlike the proposed rule that came before, won't get into scope 3. So the disclosures will be easier to track, I think, for registrants, because they won't have to go through the entire value chain to make the scope 3 disclosure unless there's a special circumstance, as Robert noted. This is going to impact annual reports and registration statements both. There's going to have to be an attestation report, and this is sort of a new player in the working group. In addition to the attorneys and the accountants and the auditors, there'll have to be a GHG emissions firm that will give an attestation report at the appropriate phase in time. The requirement for accelerated filers will be to provide what's called limited assurance about the GHG disclosures, and the requirement for large accelerated filers will be reasonable assurance. This last piece I'll mention here isn't talked about too much in a lot of the things that I've seen on this rule, but the way that this concept about limited assurance and reasonable assurance maps onto existing concepts is referring to what we talk about in the auditing of financial statements. We talk about the level of review there being unaudited or reviewed on the quarterly report, or audited financials on an annual report or a registration statement. The limited assurance will correspond to unaudited or reviewed, and reasonable assurance for large accelerated filers will correspond to audited financial statements with respect to GHG emissions.
Matt, if I might add a couple of nuances there, I think that are important for the audience. One is, to your point, I think of limited assurance as we did enough procedures and we didn't find anything that came to our attention that was materially wrong, versus reasonable being this is materially right. So think about it, positive, negative assurance. I like your quarterly review, annual financial statement perspective. I think currently the expectation is your public company auditor will also audit these disclosures, given it's upfront in the SK, and the Big Four do have the department divisions for the GHG work. The other piece I would add is controls here. While there's not a controls opinion on this is not in the SOX world. To be able to get assurance that's not qualified, you're going to need a basic level of controls. And so in addition to the SX controls around the weather events, you're going to need controls around your GHG emission calculations, similar concepts, completeness, accuracy, rights and obligations, etc. So don't take your eye off that as well. Anytime you see assurance in these rules, controls are going to come in play in some form, even if there's not a controls opinion.
I think that's a really important point. And it always revolves around The last point I was going to make on the previous slide is the way that these are reported. It's going to come down to what's called a carbon dioxide equivalent, or CO2e basis, and that's comprised of 7 specific greenhouse gases that will need to be tracked and controlled, as Robert said. Those will be reported on an aggregated basis, meaning that generally speaking, you can add together you can make an equivalent on a CO2e basis for each of those 7 gases, sum them up and report those. The exception there is if any one of those gases is individually material, they need to be broken out in the reporting. On the next slide. So now that we've talked about what the content of the rule will be, we'll talk a little bit about how this is going to get phased in, because not everything is going to happen all at once, and some things may never happen at all if your status is not accelerated. So the disclosures are going to have to be made, as Robert said earlier, in an annual report. But if there's a reason that they can't be included or shouldn't be included at that time, they can be followed up in one of 2 ways. You can either amend the 10K that was filed, or you can put out information by incorporating by reference to the next 10Q for the second quarter following the year corresponding to the 10K that was filed. If we're talking about registration statements, it's a similar concept, but slightly different timing. You're going to do that by looking at the date on EDGAR where the registration statement went effective, going back 225 days and creating the time window. And if there's a fiscal year that ends in that time window, you're going to report the GHG emissions for that year end. The phase in for this is on this table here. This is straight out of the SEC's final rule release. I think that even if the actual years change here, it's still going to be having companies think about this in year 1, year 2, and so on of the phase in. So the final rules, they start for large accelerated filers and non-accelerated filers, and all 3 categories in each of 25, 26, and 27. And so this first compliance here is the first column on this chart above, the one that says all SK and SX disclosures other than as noted. That first compliance here is going to require the stuff I talked about earlier that applies to all registrants. That's the governance piece, the plans, how to mitigate risk. That's going to kick in 25 for large accelerated, 26 for accelerated, and everyone else in 27. This second compliance here, it says in the column starting with 1502, is going to talk about the material expenditures. So what you're actually spending on making sure these disclosures are correct. That's going to be mitigating, adapting to climate risks, and the expenses for your targets and goals. This next year is for large accelerated filers, and it's going to be putting in the scope 1 and 2 emissions to the extent that they're material. So that's going to be the phase in. The very last piece is going to be tagging this, and that's going to be an extra responsibility for the EDGAR filers. Next slide. So right now, as we said at the beginning of this, these rules are not effective right now. This started out being challenged by 10 states. It was West Virginia, Alabama, Alaska, Georgia, Indiana, New Hampshire, the ones listed there. The challenge started out in the 11th Circuit. There was one later in the 5th Circuit. West Virginia took the lead on the challenge. One of the bases for the challenge that wasn't cited in the complaint, and the complaint, by the way, was very vanilla, didn't say too much, but we anticipate that the major questions doctrine that came out in 2022 out of West Virginia versus the EPA will be a basis here. And interestingly, the same West Virginia Attorney General is leading all of these other states in the challenge to this current SEC rule. So we'll see what happens. One of the things that's interesting if you follow the SEC is this is the second time that I've seen where the SEC did a voluntary stay of one of their rules. I think there's a good chance this will survive, and which is why we encourage everyone to get prepared. Next slide.
Last two knowledge check questions for those looking for CPE. Has your organization established an ESG working group, steering committee, subcommittee to address ESG related reporting requirements? I suspect most public companies on the line have started a steering committee or subcommittee. Probably not just the SEC rule, but probably ESG broader in the globe domestically. It's probably few in between that haven't started. Most companies are getting to that point of we need to figure out what to do next or how to get help, frankly. So, Jill, once you think we're at a critical mass, we can keep it moving here.
Yeah, Ben, I'd add, I think we're seeing not only the regulatory environment increase, but also customer ask increase. And so what we're really encouraging companies to think about this as is just a broader ESG reporting that may or may not be voluntary or compulsory, but should all come from the same place, the same governance structure, the same data sources. And so it really is about establishing a working group that can drive the company's response regardless of reason.
You'll go ahead to the next question, which is pretty generic for those. Just has your understanding changed, which I hope the answer is more informed, but we'll leave that up for a second. I'll kind of get started to keep us moving so we have time for Q&A at the end. The next couple slides are over governance and related internal controls, which less technical than the update we had in the first 45 minutes or so here, but more on how do companies get ready for all of the disclosure requirements, data, and frankly, who needs to be involved. So once we get to the next slide, you'll see, and like many on the line are probably experiencing or beginning to experience, the ESG landscape journey, identifying risks, opportunities, disclosures, probably is not just a legal exercise. It's probably not a controllership exercise, although a lot of times it kind of ends up there once you get to the controls. But all the functions and probably more functions on the screen are starting to get involved. If you think about communication, who may have a heavy hand in your sustainability report, HR has certain metrics, risk, finance, legal, compliance, internal audits certainly have a role in the governance aspect of all the ESG and related reporting. What we've heard and into past rules on the accounting side is ESG may either be the second coming of SOX or it's certainly more heavy-handed than the previous big accounting rules on ASC 606 for revenue or 842 for leases. And so it's required much more organizational buy-in to begin and go on and have an effective journey and process. So I'll pause there really quick. Robert, anything to add?
Yeah, I'd say a couple of things. I'd say one, partnership with legal and controllership and sustainability is very important because there is a lot of legal determination and interpretation necessary for some of these rules because frankly, some of the rules were not written fully like the SEC was. For example, California was passed, right? But they delegated to CARB to write a lot of things out and understand what's relevant. Same with the EU's rule. In certain ISSB jurisdictions coming online. So I can't underestimate the importance of, the legal team. And then I would say, like I kind of mentioned at the beginning, this is like a financial reporting process you got to put in place from scratch. As if you just bought a new company that's never been audited, what entities are in scope? What data is in scope? What are your controls? What's your tech? How do you go about reporting it in the appropriate manner? So when you think about it from that aspect and the amount of cross-functional teaming necessary for an audit or financial close, forget the audit for a second, to produce financial statements for a company, it is pretty broad. And that's just for the regulatory required reporting, not the voluntary and customer asks that are coming down the pipe.
Next slide is an overall governance illustrative, project timeline ownership of what ESG could entail, right? Up at the top, you have Chief Sustainability Officer, which may start with legal. Perhaps there is a sustainability officer on site. That person may or may not have an ESG background. Maybe they're a previous environmental health safety person or department, or maybe they're a department of one. And so implementing a strategy and the governance required, certainly a heavy lift. And so on the middle part of the slide, this is what we typically see companies and what they do to start. Where do we benchmark with other companies? How do we identify gaps and develop a roadmap even to get started? What requirements impact us throughout the globe and certainly here domestically, right? There's a lot going on in Europe. CSRD is certainly one companies, if you're impacted, need to get started. But then what's our strategy here domestically with the SEC rule in California? What we're seeing as you move from left to right is working through materiality, KPIs, enterprise risk strategy, target setting, and future audit requirements. But companies are really thinking about now those no regret type actions of, hey, we're going to need GHG inventory or an inventory management plan for our GHG emissions. We're going to need KPIs, whether we report them external or internal. Our customers are already asking for certain data, whether it's Europe or domestic. So how do we get started? And as Robert mentioned, how do we get the people, processes, and technology, which may have a lead time in place so that we can all the way to the right, frankly, report and be audited in the future. And on the bottom part of the slide, the data and the process, I think you've heard from us, Robert and I, auditors, former auditors. This is certainly the part that we're not underestimating the lift, and companies are really starting to feel the impacts of getting ready. And last piece is the controls that I'll go to on the next slide, and then pause and kick it back to Baker for comments, questions. But on the internal controls, a lot going on the slide. Really at the top and top left, it's top down. What is our strategy on internal controls? And then moving to the right, it's data, roles, responsibilities, organization capacity. Do we need training? Do we need outside advisors to help us get there? And then to the right is the formal policies, procedures. So real quick, moving to number one, define disclosure objectives. Really, what's in scope for us? Whether it's SEC, like we're talking about today, or all the other regulations that maybe impact. And the bottom two bullets in number one there, what are our current processes? What are our current controls? Do we even have relevant application systems producing the data that we need? In number two, determining relevant data, documenting end-to-end process flows, identifying data, IT system limitations. These are all things that have and need lead time, and it's where the cross-functional aspects will come in. You have operations communicating with legal, communicating with ESG. Controllership certainly wants a seat at the table with internal controls. And then number three, identifying controls and implementing controls. You have all these gaps as an organization. Okay, now we need to go plug those gaps by people, process, technology. What do we need to do? And then to the right side is, okay, we may put a control out there. Is that control and process repeatable so that we're producing the data and analysis and disclosures that we want? Are we getting the same answer? And then down the road, is it audited? Is it auditable? There's a certain training that may need to take place to be auditable, to show that paper trail, to ultimately get the assurance that you'll ultimately need, whether it's the SEC or other regulations. So I know I went through quick. I'll pause there, trying to keep us on schedule with Q&A here at the end. Robert, anything to add before we kick it back to Baker for any Q&A?
I would just add the controls in this area, even for companies that have been voluntarily reporting, it's going to be very new and a much higher level of strenuous documentation and data collection than what is typical, and not in a negative or positive way, is Excel-based aggregation. So just something to be aware of.
So this is our last CLE code, the Baker 2, for when you receive the survey at the end of the webinar. I'm not showing any Q&A questions yet, but if anyone has any, feel free to pop them in.
Certainly available for answer any comments, questions offline. I know it's very relevant sitting here in Cleveland, tornado and storms in the Midwest yesterday, so certainly a relevant topic for my physical location. But thanks for having Robert and I on the Deloitte side.
We have one question on when is the Eighth Circuit expected to rule?
Matt, Jeff, will give you
The
guys that.
Eighth Circuit has not released a timeline yet. Currently, the Eighth Circuit is collecting briefs from people and organizations who would like to give input. There is still time to do that if there is any stakeholders that have an interest in filing an amicus brief or something else relevant with the court. There is support to do that, and we're happy to help. What I'm seeing is large organizations. Jeff mentioned at the beginning of the call, the U.S. Chamber of Commerce, the Sierra Club, many trade associations coming in and writing for and against the rule for the court to consider. So we'll see.
Yeah, I would say, Matt, Kurt, is it possible this gets resolved by the end of the year? Sure. Can we tell? No. And so then, right, the next question I get is, well, Newsom in California just gave, just asked for a 2-year extension for the California rule because of the delay in their implementation. What about the SEC rule? And I don't know if you guys have seen different. I've seen no mention of that yet. It stands to reason if you go into next year. Next year was the implementation year. Something might be done, but again, we haven't heard anything yet that the effective dates we showed today are not still the applicable ones, barring the resolution. I don't know if you guys have heard something different.
I think even if we get something out of the Eighth Circuit, we can expect there's a good chance this can make it to the Supreme Court. I'm not sure whether the voluntary stay will stay in place regardless of what the courts do, because it's a fairly rare decision for the SEC to voluntarily stay a rule that they've worked for so many years on. And they may just decide to let the appeal process play all the way out to the time either when the Eighth Circuit decision's time for appeal expires or going all the way to the Supreme Court. Big question mark, but it's a good question.
Another question, how are you seeing clients handle the challenges of standardizing Scope 1 and Scope 2 data from different countries?
Want me to take that one?
Please.
So the good thing is this rule, all of the rules actually, major California, SEC, EU, ISSB, they all are based on GHG protocol, which is a standard of how to measure greenhouse gas emissions. And if you are in the industry, have been doing this, work with firms like ours to measure, there is a way to measure consistently that's not different country to country. What honestly becomes the challenge is a data challenge that's not dissimilar to any type of data, meaning the way that, for example, for Scope 2, your utility bill in Italy looks different than the US, looks different than Germany, looks different than England, but it's not a GHG or ESG specific data issue. It's just a consistent data collection methodology format that you've got to figure out, but there is a global protocol that is the underpinning for the SEC rule and others. So there is a way to measure on a consistent basis that's generally accepted globally.
Yeah, I think there was two. The big one was like the GHG protocol, was really what the SEC modeled this after. And I think that's been in place, at least in Western countries, for several years.
Yep, that's right. And then TCFD, the Task Force for Climate-Related Financial Disclosures, is the basis for the risk-based disclosures, the climate risk concept that exists in the SEC rule and others. again, it's been subsumed into the ISSB, which is, you know, the International Sustainability Standards Board. IFRS financial statements, IFRS Foundation has that, but again, a globally accepted way to measure climate risk and disclose on it. Because there is a global force, and each of these organizations have said, we want interoperability, because if we create disjointed rules with different conformity requirements, it's going to be a nightmare for people to comply. So while it's not wholly interoperable, the SEC is not interoperable with California or EU rules yet. The concepts of climate risk and GHG emissions are at this point.
And one more request to repeat what the 2-year delay in the California climate rules is.
So there's no delay yet. There was an ask by Governor Newsom for a 2-year, Matt, I don't know if you call it stay, or not really a stay, but a 2-year delay, because it was to be in effect for 25, and they're still writing the rules as we speak, but please add to that.
That's my understanding.
Yeah, so it's still effective in 25 as of now. There's just been an ask that's not been granted yet. That's a good reminder. Don't sleep on the California rule, because it's 500 million global revenue, any business in California, or $1 billion revenue globally, any business in California. So a lot of companies have been caught off guard with that.
I think
think
that's it
the-
on questions. So unless there's anything else, just a reminder to anyone who's looking for CLE, you'll be prompted with a survey as the webinar ends. And if you miss it, don't worry, you'll get it in a thank you email, and you can fill it out there to get your CLE. If you filled in the polls for CPE, you'll get that as well. You won't need to do anything further there.
I think we're great. I appreciate everybody joining today. I think we're just about at 1:30, and appreciate everybody participating.